We will now discuss financial statements. We have two statements to be prepared from your trial balance you already prepared. From the trial balance, you have to prepare two financial statements. One is all about income statement. Another one is all about financial statement, financial position statement. Financial position statement. These are the two statements supposed to be prepared. And while preparing from the trial balance, you may have few adjustments to be carried over, especially closing inventory and others. Predominantly you will have the closing inventories and others also. Okay. Debit side and credit side. From here I am going to transfer to the income statement. So how do we prepare? So I have given the steps here. Prepare the income statement and statement of financial position. Two statements are going to be prepared. First of all, the list of accounts given in the trial balance, identify where this will go. In income statement, we have two segments. One is all about trading section. Another one is all about profit and loss section. In trading also we have income and expenses. Here also we have income and expenses. In financial position statement we have, so in financial statement we have predominantly two parts. One is all about asset, another one is all about capital and liabilities. Capital and liabilities. You have to identify from the trial balance where this will go. Okay, this may go to one of the four blocks. Say each and every item given here you can identify whether it will go to trading income side or trading expenses side or profit and loss income side, profit and loss expenses side, or asset or capital and liabilities. First identify all these things. So identify the placement of each item in the trial balance, mark whether each account belongs in income statement or statement of financial position. And if the items given in the trial balance should be recorded only once, either it may be posted in the income statement or financial statement. Okay, because the entry is already over. All the values recorded here will be posted only once. Okay, in case, apply adjustment using double effect rule. In case of adjustments, you have to follow double effect rule. Okay, before you transfer to the income statement. Write twice. Okay, that's the logic. So you can cross verify you have done this or not properly, then there will not be error at all. Each adjustment must be recorded twice, one debit or one credit, one debit and one credit, or one addition and one deduction slide. The common adjustments you have to come across in this chapter being, in case of outstanding expenses or accrued income, prepaid expenses and income, capital expenditure wrongly recorded as a revenue expenditure or vice versa, you need to do those adjustments also. How do we handle in case of irrecoverable debt and provision for doubtful debts while preparing the financial statements? Depreciation related adjustments, closing stock. Usually you have the closing stock in all the illustrations. Rest of the things will be applicable or available only depending upon the situations. Okay, rarely. Okay. And all these things shown twice, deducted from purchase. This closing stock will be shown twice because it's an adjustment item. Usually it is deducted from the purchases as well as it will be shown as current asset. It should be posted twice. Step number 3 is over. Okay. So you need to understand how to handle all these adjustments much ahead of preparing a comprehensive illustration. And fourth step, prepare the income statement. So by preparing the income statement, you can easily identify, by preparing the trading account, you will get the gross margin, gross profit. And by preparing the P&L account, you will get the profit for the year. This profit will be transferable to the owner's fund, capital fund. Okay. And then, so here determine gross profit, net profit, final profit or loss and all. Prepare capital account and statement of financial position. Finally, you prepare capital account. So because you have to adjust this here. After adjustment, you prepare the financial position statement. Okay. In preparing capital account, you have to subtract the drawings, any additional capital given by the owner, and net profit will be added. So then present the assets and liabilities. Thereafter, you can present the assets and liabilities here totally. Here first you have the capital, and next block you'll have the liabilities. Okay. Here you need to do lots of adjustments. So finally, if you total the assets and total the capital and liabilities, both should match. Then you have done perfectly without any error. Hope you will be now able to understand the simple structure. So from the trial balance, you are going to prepare the income statement as well as financial position statement. So whatever, see, first step is you identify whether the items are transferable to the trading income, trading expenses, or profit and loss income, or profit and loss expenses item, or will it go to the asset side of the financial position statement or capital and liability side of the financial position statement. All the things available in trial balance should be posted only once, and if it is given in adjustment, it can be posted twice. So usually you have the closing inventory that will be adjusted with the purchases as well as considered as current assets, but others. What are the other common adjustments you have to be mastered here is outstanding expenses and income, prepaid expenses and income, capital expenditure wrongly recorded as a revenue expenditure, and irrecoverable debt and provision for doubtful debts to be adjusted, and depreciation as well as closing stock also to be adjusted. So these are the content you have to be mastered with. I have given the format here for your better understanding. So in case of income statement, we'll start with the revenue. If there is closing stock, this ultimate item will be a cost of sales. From the revenue, if you subtract the cost of sales, you will get the gross profit. Hope you'll be now able to understand. And this first block will be called as trading section. This will be called as trading section. And with that gross profit, any other revenue not falling under the sales main revenue will be named as other revenue, will be added. Okay. With this gross profit to get the total net revenue identifiable for profit for the year. From there, other expenses will be subtracted. You will get the profit from operation, and you need to subtract the loan interest also. Then you will get the profit for the year. Profit for the year. This second block is called profit and loss section. Hope you will be now able to understand the income statement for the year ended. Okay, so let me brief again. Revenue less sales return, net sales, and from there cost of sales should be subtracted. The cost of sales being opening inventory, purchases, from there closing inventory side. This will be the first section called the trading section. And in case of profit and loss section, you have to add the other revenue with this, so you will get the total revenue. And this total revenue is not going to be added to the owner's fund because there may be some expenses. Those expenses not falling related to the purchases will be now taken here, and that will be subtracted before interest on loan. So if you subtract this, then you will get the profit from operation. From there, loan interest is subtracted to get the profit for the year. Now, in case of financial position statement, usually financial position statement is for a particular date, so we have to write after financial statement at that particular date. And in case of income statement, it is for the year ended, so it represents for a period of say 6 months or 1 year. Predominantly we follow for a 1 year. Okay, hope you will be now able to understand. In case of financial position statement, two predominant blocks are there. One is assets, another one is capital and liabilities. Capital and liabilities. Under assets, we have two blocks: non-current assets and non-current assets as well as current assets. Okay, non-current assets and current assets. So these are the two blocks: block 1 and block 2. Under capital and liabilities, we have again three blocks: capital, liabilities, non-current liabilities, and current liabilities. So these are the three blocks. In case of non-current assets, again we can classify the two part: the non-current assets what you have being in the form of tangibility will be called as tangible assets, and non-current assets being in the form of intangibility will also be blocked. In case of tangible, the examples are being land and building, machinery, fixtures and equipment, and motor vehicles, or any other assets you come across. Check whether it is tangible, like goodwill, brand names and trademarks. So goodwill, brand name, trademarks are still having the value for the organization, but of course we cannot see that, so it is called intangible. So we can have two blocks. In case of capital and liabilities, owner's fund will be capital and the liabilities being again subdivided into two liabilities, non-current liabilities as well as current liabilities. Now the difference between current and non-current being, in case of asset, non-current assets means the assets will be convertible into cash or not convertible into the cash. Convertible into the cash only after 12 months, or usually not convertible only at the time of closure of the business or at the time of expiry of the asset can be sold. Until that time it will not be saleable. That is called non-current. But in case of current assets, all these things are encashable within less than or equivalent to 12 months. Similarly, non-current liabilities, the liabilities payable after 12 months will be falling under non-current liabilities, like long-term loan and mortgages will fall here. In case of current liabilities, it should be payable within 12 months will be called as current liabilities. Hope you will be now able to understand the vertical format of income statement and financial position statement. Opening inventory plus purchases you will get minus closing inventory, you will get this only. Now we will see one after one. Hope you will just recollect all the points what you have. Come on, you can guess with me. So in income statement, what you have? Income statement, for your memory purpose you can do the revision. Revenue minus sales return, that will be called as your net return, and from that you have to subtract cost of sales. Under cost of sales, opening stock, purchases, opening stock and purchases. From there you have to subtract closing stock or inventory. Okay, then the value what you get is called cost of sales, and from this revenue if you subtract this you will get the gross profit. This is how you can do the memory. Okay, and this will be profit segment. In the second segment I start with other income. Other income will be addable with this. Okay, then you have to subtract other expenses other than interest on the loan. Okay, you have to subtract this, you will be getting profit from operation. This is called profit from operation. Is that okay? From there interest on loan can be subtracted. If you subtract interest on loan, then ultimate value will be called as profit. This is the profit for the year. Clear? Hope now you will be able to understand or memorize this format. In case of balance sheet, will be named as in financial position statement. Financial position statement. First block is all about asset. Under that asset we have non-current assets, tangible, non-current assets, intangible form, and current assets. These are the three predominant items we have here. And in case of second block, capital and liabilities, under that we have first block being capital, second block being non-current liabilities, third block being current liabilities. So if you add up the capital and liabilities and compare, this will be total to the total assets. So these two will be matching. Okay, in case of non-current liabilities, the liability payable after 12 months will come under this, and the liabilities will be payable within 12 months will fall under this. The same way, current assets are going to be encashable within 12 months will come under this, and otherwise this will fall under non-current assets and non-current assets, tangible and intangible. While preparing the financial position statement, capital account should be prepared after doing some additions of the profit. Hope you will be now able to understand and recollected the format. Let's see. We will now deal the purchases. I have given in the working note number 1 related to the calculation of purchases in detail. Let's see. Purchases means whatever the things you purchase will not be purchases alone. See, from X, you purchased the material for ₹1,000. Okay, the material will not come to your place automatically. You have to incur some freight and carriages. That is called carriage inward. So unless you incur this amount, it will not come to your place. Any cost you incur to bring it to your place will also be addable. And out of that goods received, an item of rupees 100 not fit enough for your usage, so you simply return that. So that will be around 100 rupees. What you have to do? 1000 rupees being purchases and 50 rupees being carriage. Okay, this is purchases, this is a return, and sometimes the asset purchased by him, can be used by owner he himself. He takes to his own home. Okay, personal purpose. It should be used only for the business, no? Rather than he uses for the business purpose, he takes it for personal purpose, personal property. So what you have to do, what is the real purchases value used for the business is identifiable. Out of the 1000 plus 50, 1050 rupees you spend for the purchases, 150 is used for own purpose, is not for the business purpose, should be subtracted. Another 100 rupees worth of goods not fit enough, you return. So from the 1050, you have to subtract 250, then automatically amount 800 rupees is considered as purchases used for the business purpose. So you have to find out the purchases for the business purpose. That will be the value to be posted here. Understand? So here see, I started with the original purchases. From there, any returns you have done, subtracted. Goods taken for own use will be called as drawings, and any amount spent for bringing the goods to your place will be called as carriage inward. That will be addable. So the total value will be the adjusted purchase that will be shown here. Number 1 is over. Clear? Like this, each and every aspects are going to be covered. In case of, I hope now you will be clear with this purchases. How can we calculate the purchases? If you are clear, let me know. Now we will go for the other revenue and other expenses cases. What will come under other revenue and other expenses? We'll see the first list, and then is there any adjustment? If there is any adjustment, how can we adjust? Those things also be studied in working note number 2 and 6. I am going to refer. Okay. So in working note number 2, I have given the list of other revenue and other expenses. What are coming under other revenue? What are coming under other revenue? Okay. Let's see. Now, discount received, commission received. If you have provision for doubtful debts, compared to the previous year, in this year, the value decreases, means the revenue like you can show. So these are the items will come under other revenue and expenses. Then what about the other expenses? Wages, insurance, whatever it may be. You can guess yourself any expenses not listed an earlier case like electricity, even discount receipt, discount paid, make a correction. So discount paid, discount allowed. Okay. Discount received and discount allowed. Clear? So the discount allowed will be considered as your other expenses. And apart from that, you have to understand how to handle with respect to the 3 more items: depreciation, irrecoverable debt, and increase in PDD. Increase in PDD. Okay. Increase in PDD. Once again. Now, so we'll see the depreciation part later. Now, depreciation is also the value of asset decreased due to the utilization will also be expenses, and any amount recoverable from our buyer customers could not be payable because of his own financial condition will be named as irrecoverable debt, also loss. And compared to the previous year, the PDD you have provision for doubtful debts you have created is increased, then it is also your expenses. These are the illustrative purpose I have given a few examples for the other in revenue and other expenses. Apart from that, we have to study depreciation, irrecoverable debt, and increase in provision for doubtful debts in detail. Okay. Before we see that, let me try to finish off this one also. What will come under current assets and what will come under current liabilities? The current assets items are assets convertible into cash within 12 months will be called as current asset. If the current liabilities are going to be payable or liabilities are payable within 12 months will be called as current liabilities. Okay. Now what are the items will fall under that? So we'll see that example here. So some examples are being inventory, trade receivables, bank and cash. These are the current assets. And in current liabilities, trade payables, bank overdraft being the current liabilities. And remember, the difference between current assets and current liabilities is named as working capital. Working capital. And apart from that, these two are very interesting aspects. Other receivables as current liabilities too. Should not forget this one. You have to understand clearly with studying further along with the working out numbers. So the depreciations are of two models, right? One is straight line method of depreciation. Another one is depreciation on net book value or reducing book value method. So you have to follow RBM method. So you have the two methods here. So the original cost of the assets being 1000 rupees, and whatever the accumulated provision for depreciation of the asset you have since the date of purchase will be subtracted. After subtracting, you will get the net book value. Now, if the rate of depreciation given as 20%, and if you supposed to calculate under SLM method, you have to take the original cost on that this 20% will be applied. So, for example, 1000 means 1000 into 20%, 200 rupees. Same, if you are going to calculate the depreciation at the rate of 20% on RBM method, means you have to take the net book value. Net book value is nothing but the amount you calculated after subtracting the provision for depreciation from the cost. So this value will be taken here. So 400 rupees. On that 400 rupees, 20% is calculated. That's one of your expenses. Hope you will be now able to understand this part. Clear? Now, what about the adjustments of expenses income? Okay. See, for example, 1000 rupees is your, okay, 1000 rupees or $1000 will be your rent per month. Okay. For 12 months period, rent paid being should be 12,000, no problem, right? Per month 1000 is, for 12 months it is 12,000 rupees. But the rent actually paid being only 11,000. What is it supposed to pay further? This is called outstanding expenses. In case of outstanding expenses, shortage of the rent applicable for the period, the shortage of the rent applicable for the period here being 1,000 rupees, because it's currently we have only 11,000 rupees. The shortage 1,000 will be now included here. Is that okay? Then the actual rent will be 12,000. Clear? Now, the actual rental expenses being this 12,000, this is the expenses. And what about this 1,000? We supposed to pay later on? No. This becomes a liability and payable within a short period. Then it is considered as current liabilities. So whenever there is an outstanding expenses like rent paid, you have to adjust twice, because it is usually given in the adjustment. It should be posted twice or adjusted twice. One is it should be posted in the current liabilities, another one is it should be addable with the expenses. Hope you will be now able to understand. Next. If the rent paid being 13,000 rupees, how much you have to pay? Only 12,000, but you have paid 13,000 rupees. You paid additionally, means next period you no need to pay. The rent for the next period is paid this month itself. That's called rent paid in advance. That rent paid in advance should also be removed. Need to find out what is the rent for the period. That is your expenses, not the paid. So I am going to remove that 1,000 rupees here. After removing, the rent applicable for the period is only 12,000. This only will be called as expenses. This amount will be called as advance expenses, or expenses paid, or prepaid expenses. Expenses paid in advance. This expenses paid in advance be your current asset and also subtracted from the rent account. Here it is added and subtracted. Okay. So these are the points you have to be careful. So for the adjustment regarding the expenses, actual payment usually appears in the cash book, and finally it is appearing in the trial balance also. And any outstanding, means not matching for the period of your accounting preparation, then to the extent of shortage will be called as outstanding. It should be added, not only added, addition is one entry, and it should be considered as current liabilities. It should be posted in the current liabilities second entry. So two entries will be passed. In case if you pay extra, that will be called as advances, that will be subtracted. Okay, first entry. And not only that, the subtracted item is supposed to pay later on. No, you are liable to pay. But remember, in case of outstanding expenses, add and current liabilities. In case of advance expenses or prepaid expenses, less and current asset. Same happens in case of income. You can understand the other way. For example, rent paid. Rather than rent paid, we assume we let out our rental property or property, then rent received will be there, right? The actual rent received being per month, it is 500 rupees, 500 rupees per month. So the rent received for the period should be how much? Per month 500 means for the 12 months period, usually it should be 6,000. If it is 6,000, no problem. But rent received being only 5,500. What happens? Outstanding rent recoverable. Otherwise, this is called accrued. Accrued rent. That 500 rupees should be addable. So the ultimate value being 6,000. The ultimate value being 6,000. Is that clear? That's how you can do. This is added. Any outstanding or accrued should be addable. Not only that, this amount you supposed to recover later on. No, you are enjoying this benefit later on. Somebody is owing to you, then it is your asset named as current asset. Entry 1 and entry 2. Okay, in case of payment, the amount received lesser than the amount supposed to be received. So the outstanding or accrued will be addable, adjustment number 1, and it will be posted as current asset, adjustment number 2. And similarly, if the rent received being 7,000, what does it mean? You are eligible for only 6,000, but you got 7,000 rupees, 1,000 additionally. That is not for this period. It may be for the next period. So next period, you need to give your premises for rental without any money collection, means you are liable. So you have to subtract this one. This will be called as prepaid or advance income. So that will be subtracted. As well as you received in advance means you are liable, so it will be named as current liabilities. So 6,000 is the final value. Okay. So one adjustment being it is subtracted, another adjustment being it will be considered as current liabilities. Is that clear? So here you see, in case of other receivables and accrued income, okay, we have seen in working out number 6 and 7 will be your current assets, and other payables and prepaid income will be current liabilities. Other payables you supposed to pay, you are liable. You collected the money advance, you are liable. In these two cases, this is liable. Any amount you supposed to pay remains pending, liability. Any amount you recovered for ahead, then also you are liable. And any amount supposed to be receivable remains pending, not received, you are liable. You are being the owner and asset. And any income receivable not received, then also you are being owner of that, or somebody is liable for you, it's your asset. So these are the two cases. Not only that, it will be adjusted in the asset account, means concern expenses also. After adding, you get this expenses perfect. You do plus or minus with this. Hope you will be now able to understand the treatment of current as means this one adjustment for expenses as well as adjustments for income. Let me summarize. In case of outstanding expenses, add current liabilities, and prepaid expenses minus and current assets, and accrued income add and current assets, and prepaid income, it is not related to your period, minus and this is current liabilities. This is the simple step. One adjustment here, another adjustment being here. You have to post these two places simultaneously. Clear? We'll go for an error type, mistake. Sometimes the capital expenditure is treated as revenue expenditure. For example, wages paid for installation of a machine. Usually this cost will be addable with the machine, but we get tempted to write this being expenses as it is named as wages. So, which is the correct one? Showing this as a part of machine is correct, not being the wages. Is that okay? Any asset you purchase until it gets settled, installed, ready for use, any expenses you spend, like a carriage, you pay for bringing it to your place, and wages you are paying for installation, and any trial run you go for testing before you take it granted, take it for your usage. All these things will be part of your machine cost, should be named as machine. See, we have wages 10,000 rupees and a machine 1 lakh rupees. What happened, you know, the wages paid for installation of machine 5,000. They have shown this being the wages wrongly, added black. What about this one? Wages for installation. Wages for installation. Or any second-hand machine, used machine, if you are purchasing pre-owned machines, before it get ready you have to do some repair in the initial stage. That is also capital expenditure. Capital expenditure means it should be part of the machine. So here they should record this value as a part of machine cost, but they have considered this being the wages wrong. How do we now rectify? It should be added to the machine or rectify. It should be added to the machine only, no, wrongly added to the wages. So rectification will be done this way. You have to subtract from here and add here. So then the adjusted or correct value being wages being 10,000 and your machine being 1,05,000. This will be the corrected one. So if there is any capital expenditure maybe mistakenly treated as revenue expenditure, then you have to undergo the rectification of this particular error. Subtract the amount wrongly debited to revenue expenditure and add the amount to the appropriate asset account. Sometimes the expenses, revenue expenditure may be considered as capital expenditure. That is also wrong. You have to adjust both the cases. Clear? How do you do the adjustment? So this is what about the 8th one. Expenses paid minus capital expenditure means the expenses incurred for machine is added, means you have to subtract. That is what about the one more adjustment you have to do here. Another record will be, it should be added to the asset account. You have to add this. So you have to understand that in case of error, how can we rectify? You have to rectify to the concerned capital asset as well as concerned revenue expenditure. Clear? Hope you will be now able to understand the 8th one. Now, what happens for the 9th one? Irrecoverable debt and provision for doubtful debts. So we have seen already a list of expenses. Here we have completed the depreciation concept. Now I am going to teach you irrecoverable debt and increase in PDD in case decrease in PDD. How can we adjust these two? Is that clear? 9th adjustment. 9th adjustment. Okay. Now, what is called irrecoverable debt? Irrecoverable debt is nothing but the amount recoverable from our customers for the credit sale. Because of his financial position, he may be bankrupt. Because of that reason, we cannot recover. So that amount is our loss, should be subtracted from overall amount recoverable from various debtors or various trade receivables. That subtracted value will be your expenses. Should have two impact. One is subtracting from debtors, another one is it should be shown as your expenses in your income statement. Number one, number two, two statements, two record. After that, whatever the value you have balance, that is what about the current asset shown in the books. Current asset shown in the books. Clear? This is all about irrecoverable debt. Whenever there is an irrecoverable debt, that will be subtracted from the trade receivable. Balance will be your current asset shown in the current assets section of your balance sheet, in a financial statement, financial position statement. In case of the amount subtracted, that will be your loss or expenses will be shown in your income statement, P&L section. This will go to the P&L section. Okay, profit and loss section. Now, if you expect that there may be loss, you can make a provision for that. So for the double cautious, that is called provision for doubtful debts. Usually, provision given as 5%, whatever it may be, some percentage may be given. It may be 5%, 6%, 3%, You calculate the provision for doubtful debts for the closing period using this adjusted trade receivables, not this one, not this one. Is that okay? Only after adjusting the irrecoverable debt. Usually this irrecoverable debt given in the adjustment, below the trial balance. After adjusting whatever the final value on that 5% will be calculated, that is called provision for doubtful debts closing. Now this closing value is compared with, so 1000 rupees, 200 rupees is irrecoverable debt, today 800 rupees. Now I have to create the PDD closing. PDD closing being 40 rupees. But last year also we may create the PDD, no? We may have the PDD the previous year, opening PDD, that will be named as opening PDD. This will be given in the trial balance. This is given in trial balance. If that value being 35, what happens? Compared to the previous balance we have, now we have to increase by 5. If the PDD is increasing, it's your expenses and will be considered as other expenses in P&L section, profit and loss section. Is that okay? Suppose in the previous year, if you have 55 rupees, compared to the previous year, this year you are reducing it to 40. Reducing 15. If you are reducing, this is your income. So, with respect to the receivables, you have two adjustments. One is irrecoverable debt. Another one is what happens to the PDD. Is it increasing or decreasing compared to the earlier year balance, opening balance? The opening balance is given in the trial balance. Closing balance, usually the rate is given in the adjustments. The rate given in the adjustments. If you compare with the previous year and current year, if it is increasing, it is your expenses transferred to the P&L section as expenses. If it's clear? Okay, now let's move on to the balance sheet. While preparing financial statement, financial position, capital will be calculated, How do we calculate? The 10th working note is going to be studied here. The owner's fund. What the owner has in the very beginning will be the balance in the beginning. Usually it's a liability like credit balance. So, credit balance should have opening in the credit side, closing in the debit side. When the amount payable by the entity to the owner is increasing, should be posted in the credit side. If it is decreasing, it should be posted in the debit side. After preparation of financial income statement, you either get profit or loss. If you are getting the profit, owner's money will be increasing, means entity has to pay him additionally. That will be shown here. In case of loss, it should be posted the other side. Apart from introduce additional capital also, that will also increases the amount payable by the entity to the owner, should be in the credit side, and he may withdraw some money for his personal use. He may withdraw by way of cash, or sometimes it may be purchased goods also. Whatever it may be, these two are called drawings. It will be decreasing the amount payable to the owner fund. After calculations, you get it will go to the capital and liability section of the financial position statement. Okay, under capital. Is that clear? See here. How do we get the capital here? We have studied in 10th working note. Now, I have to cover two more aspects. Sometimes you need to know inventory details also. Inventory is an asset, especially current assets. Whatever the inventory you have in the, so whenever it is being the asset, opening should be in the debit side, closing should be in the credit side. Okay, again BD, brought down should be in the debit side only. Brought down should be debit side, balance carried on should be in the credit side. And whenever the asset increases, the current asset, this is current asset, okay. If the current asset increases, should be posted in the debit side. If it is decreasing, it should be posted in the credit side. When it is increasing, if you are purchasing, then it will be increasing. Maybe cash purchase or credit purchase. When it is going to be decreasing, once you sold this item, it will be decreasing the balance of this. Sometimes the asset may be, stock may be taken by the owners as named as goods. That will also be reducing. That also reduces. This will be called as inventory account. This will be called as inventory account format. Even sometimes sales return may also be there. Cost of sales return may also be there. But anyway, you just understand that. This one, that part we will see later on once it comes. Hope you will be now able to understand the inventory account. This one is required to find out any closing stock available or any purchased item to be calculated if it is not given in the question. So you need to understand this inventory account also. Let's now move on to the margin. You have to understand the last adjustments before we go for the comprehensive illustration. Okay. And 13th one is very simple. So 13 adjustments I am going to guide you here. The 12th point to be noted while preparing the financial statement being understanding margin and markup. See, if the cost being 1000 and your gross profit being 200 and your revenue being 1200. Whenever it is being margin, you have to find out gross profit. In the denominator, you need to have the sales. 200 divided by 1200. You can represent in percentage. 16.67 percentage or 17 percentage. I can round off to the whole number, 17 percentage. Whenever the statement being marked up, gross profit should be in the numerator. In denominator, you have to take the cost of sales into 100. Then 20 percentage. So under markup, cost of sales is 100, under margin, sales is 100. Clear? So you have to understand the difference between margin and markup. To make you understand further, let me solve an illustration here. So we have to find out the gross profit. Sales is 1000. Okay. Sales is 1000. Find out gross profit if profit margin is 20%. Profit margin is 20%. In case profit margin 20%, you have this structure here, cost plus profit, you will get the sales. This will be for percentage. 20% means if you are talking about margin, okay, automatically it is on sale only, on sale only, means sale is 100. In case of margin, sale is 100. Sale is 100. Is that okay? And this 20 is always profit. With the cost, profit 20 is added to get the sales, means what could be the cost? Using the cross working or reverse working, you will get the cost being 80. Now, what is the information given here? 1000 being sales. You put that 1000 here. Now, what is the requirement? You have to find out the gross profit. How can you calculate the gross profit? You can do the cross multiplication to arrive this. So, 1000 into 20 by 100. 200 will be the value. Now, if markup is equal to 20%, markup is equal to 20%. Markup 20% means cost is equal to 100. Cost is equal to 100. Then again the same format, cost add profit, sales is given, you have to find out the profit. You have to do the cross multiplication to get this profit. 1000 into 20 by 120, 16.67%, rounded off to 17%, rounded off to closer number, 17%. Hope you will be now able to understand this. Okay, 167 in numbers, 167. Is that clear? In numbers. The given details in this illustration being sales. What happens if a given detail is cost? Shall we work out that one also? If you are clear, let me know so that I will go for the next one. Clear? Now, Here, the purchases, the cost price is given. Cost price is given. Find the gross profit if the profit margin is 20%. So, first question is all about profit margin 20%. If it is so, sales is equal to 100. Am I right? Sales is equal to 100. Right here, cost or purchases plus profit. Profit is otherwise named as markup. You can name markup also for this, and the value what you get is the sales. Percentage column. Sales being 100, profit being the given information or margin, cost should be, if you are adding the cost and profit, you will get the sales, and the reverse calculation 100 minus 20, 80 is the cost. 80 is the cost. Here, we have been given purchases. Purchases is nothing but cost. Means 80 equivalent value is 1000. Here the profit is equal to 1000 into 20 by 80. Then final value is 250. Clear? 250. Let me go for the next one. Purchases $1,000, find out the gross profit. Okay. Now, markup is given. Markup is equal to 20%. Markup is equal to 20%. In this case, cost is assumed to be 100. Cost is assumed to be 100. So, cost plus profit, then you will get the sales. Percentage and dollar column. So, cost is assumed to be 100, profit is the given value, sales should be 100 plus 20, 120. Now, purchase information 1000 given, you have to find out the gross profit. Purchase means cost, so you have to equate with this one. And our requirement is to calculate the profit, you can do the cross multiplication. 1000 into 20 by 100. The ultimate value being 200 rupees here. Clear? Hope now you will be able to understand the markup and margin concept, and markup and margin. If the value given being either purchase or sales, how can we approach? In all the cases, simple format I have given here. Clear? So, up to now you are very clear, I hope. This 13th one, it is better to know. You might have studied this for this one you could have studied in other chapters also. Sometimes you need to prepare debtors account and creditors account also. Okay. Because credit sales and credit purchases may be missed to be given. Now it's your duty to find out that credit sales and credit purchases. That may be possible only by preparing these two working notes. Debtors being the current assets, receivables, otherwise this will be receivables and this is payable. This is current asset. This is current asset, sorry, debtors being the current assets and this is being current liabilities. Asset will have opening balance, balance brought down in the debit side and balance carried down should be in the credit side. The transaction increases the debtors value, amount recovered from them will be posted on the debit side. The transaction reduces will be posted on the other side. Especially credit sales increases, sales return and amount collection, discount allowed will reduce the balance. In case if the bank check dishonored should be posted on the other side. In case of creditors, payables, trade payables, this will be called as trade payables. This is trade receivables. Being the current liabilities should be posted in the credit side in the starting, balance brought down, balance carried on should be in the debit side. The amount payable to them, recoverable from them, payable to them is increasing, should be posted in the credit side. If it is decreasing, it should be posted on the debit side. If you are purchasing further credit, this will be increasing, and if you are returning the goods unfit, will be reducing the amount or commitment payable to the creditors. Payment may be in the form of cash or bank, or we may avail some discount. These are the three transaction reduces. So here sometimes the purchases may be missing data like, and the sales may also be missing data like, you can find out. This is credit purchase. For that it is better to know this one, though you might have studied in the earlier chapters. Now we will start solving some illustrations from past year's question papers. This question number 1, Jabir owns an electrical wholesale business. This question was asked in October-June 2021, carrying 2 marks. What is the requirement? Calculate the gross profit and profit for the year. So you have to calculate these two. So this is nothing but income statement. As you know, the income statement, revenue less sales written and from there you have to subtract cost of sales. Under cost of sales, we start with opening purchases, opening inventory and purchases. From there closing inventory will be subtracted. Okay. The difference between the net revenue and cost of sales will be the gross margin, gross profit. With that, if you have any other operating income, you can add, other expenses can be subtracted. So the following balances appeared in his books on 30th September 2021. So the inventory on 1st October 2020 was 11,000. This information is for the closing and this will be the opening. This is opening inventory. This inventory belongs to 30th September 2021, so it's closing. So closing inventory 8,000 rupees. Purchases 1,09,000. Trade payables being a liability, current liability will not come here. Revenue 1,60,000. 1,60,000. And trade receivable being the current asset. Operating expenses, from the gross profit you have to subtract the operating expenses, 35,200. You will get the profit for the year. Profit for the year. So the opening inventory being 11,000. We don't have sales written, only 1,60,000 being the value we have. And 11,000 plus 1,09,000, 1,20,000. From there 8,000 is subtracted, 1,12,000. From 160, 112 is subtracted to get the gross profit, 48,000. Operating expenses 35,200 will be subtracted, so ultimate profit being 12,800. For the gross profit calculation, it carries 1 mark, and for this 1 mark you will be able to get this. Okay, 2 marks. This is how the mark also be awarded in your answer script. Calculate gross margin for this 2 mark. For the calculation of gross margin, you have to find out the gross profit first, or if you have this, the gross profit by sales will be taken into 100. Gross profit being 48,000 and your sales revenue being 1,60,000 into 100. Then the ultimate value will be getting here being 30%. For this again we will be able to get another 2 marks, 4 marks. Let me now find out the markup also. But it was not asked in the exam, but you need to understand the difference between markup as well as margin. I may calculate this one also for the additional learning. Here the formula being gross profit. In case of markup, we calculate based on the cost. Cost means purchases into 100. Is that okay? This is the order you have to follow. Cost means cost of sales can be taken. Okay, cost of sales. Cost of sales. If there is no stock, then purchases is equal to cost. Okay. Now gross profit being 48,000, cost of sales being 1,12,000, and you can represent that in percentage. So 42.86 percentage. 42.86 percentage. Hope you will be now able to understand the difference between gross margin and markup. Fatima is a sole trader. She prepares her financial statements to the end of March each year. At 31st March 2022, Fatima's ledger account balances included the following. So these are the items given there. And we have been given the adjustments also in this illustration. So we have to incorporate these adjustments while preparing income statement. Requirement: prepare Fatima's income statement and prepare Fatima's capital account. Prepare Fatima's capital account and bring the balance of the account down. Okay. For the income statement, 11 marks. For the capital account, 4 mark. Okay. See, income statement. Whenever it is all about income statement, basic format you can finish up writing here. And you need to find out where these items will go. So already I told you now the steps. Okay. Identify the placement of each item in the trial balance. What are the items given in the trial balance? Now you have to get me the details where this will go. And adjustments to be incorporated. These things are incorporated twice, or adjusted twice in 2 places. And then this trial balance item will be transferable to only one place, and finally you can prepare income statement and capital account, and finally statement of financial positions. So my first work is to find out where this item will go. These items will go, right? Revenue, trading income, sales return, revenue, trading expenses. You have to subtract this. Purchases, trading expenses, rent and rates, profit and loss expenses, wages, profit and loss expenses, general expenses, profit and loss expenses, insurance, profit and loss expenses, discount received, profit and loss income. This is opening inventory. Opening inventory being trade expenses should be addable with the purchases. Fixtures and equipment and cost, and the provision for depreciation is also given there. Okay, assets and provisions. It will not come in income statement. You never bother about that. So anyhow, this will be non-current assets. This will be provisions to be adjusted there itself. Trade receivable, current assets, trade payables, current liabilities. Provision for doubtful debts will be adjusted with the trade receivables. Trade receivables. Cash drawings will be subtracted in the capital, and capital also be considered as a capital item. Now you mark down. Before you transfer, finish up the adjustments. After that you can transfer. So adjustments should be incorporated in 2 different places. Okay. The following information is also available. Number 1 being inventory. This is closing inventory. It will be taken to 2 places. One is subtract from the cost of sales. Another one is it will be current asset. Fatima took goods for her own use from the business during the year. These goods cost rupees 1,300. So drawings will be subtracted from here, from the purchases. Okay, the value being 1,300 should be subtracted from the purchases, and it will be part of the drawing. So I add here cash drawings and goods drawings 1,300. 1,300. So we can write parallelly. see, you recorded twice. Here you deducted and here you subtracted. Okay, so added. Number 2 is over. Depreciation on fixtures and equipment is to be charged at the rate of 20% per annum using reducing balance method. So 20%. So depreciation being the trading expenses, profit and loss section expenses, and 20% will be provided on reducing balance method. So then you have to subtract the provision for depreciation. On the balance you have to calculate 20%. This is over. Accrued wages. Accrued wages means outstanding. So 800 rupees. It should be added to the wages, 800. Another place it will be current liabilities. Anyhow, we are not going to prepare this. You state this being the current liabilities, that's all. So another record being current liabilities. Anyhow, we are not going to prepare the balance sheet, so never bother about the second entry. And rent included a payment of rupees 1500 for the 3 months from 1st March 2022 to 31st May 2022. What is the year end for us? 31st March 2022 being the year end. So this rent being belonging to 1st March 22 to 31st May 22, but we have to prepare up to 31st March 22 only. For this entire period, the overall rent payment being 1500. Here, only to the extent of this current year will be included as your expenses. Okay, this may be 1 month. After this is 31st May, okay. After March we have how many months, sir? 2 months. 2 months. For 1 plus 2, 3 months, 1500 means for the 1 month it is 500 rupees. For the remaining 2 months it may be 1000. This will be your expenses only. This will be considered as prepaid expenses. Prepaid expenses. We found out the prepaid expenses here. In case of prepaid expenses, you have to subtract from the concerned expenses. So in rent it will be subtracted 1000 and it will be part of, as you pay the expenses in advance, it will be current assets. Anyhow, I am not going to prepare the current assets and current liabilities here. You don't need to worry about that. And now let's go for the sixth one. An irrecoverable trade receivable 200 is to be written off. Irrecoverable. So trade receivables you have, in that we have irrecoverable debt being 200 rupees. 200 rupees. So this irrecoverable debt will be profit and loss section expenses related to the profit and loss. Is that okay? Next one being the provision for doubtful debt is to be set at 3% on trade receivables. So you have to create the provision for doubtful debts. While creating the provision for the doubtful debts, how do you create this one? 6,400 irrecoverable debt to 200 is subtracted. Okay, after subtracting, on that you have to calculate at the rate of 3%. So 3% is calculated. 6,200 into 3%, 186. This is what about the closing value, but opening we already have how much? 156. Means there is increase in provision for doubtful debts by 30. Any increase will be named as profit and loss section expenses. If it is decreasing, then it's income, but in this case it is increasing, so it's an expenses. So we have marked down all these things. Now we can prepare the income statement easily from this information. Okay. Now revenue. We'll start with revenue. Revenue being this one, 79,400 minus sales return. Sales return being 3,970 and balance value being 75,430. And from there you have to subtract cost of sales. Cost of sales. Under cost of sales, purchases. Opening inventory. We'll start with opening inventory. Opening inventory. Okay. Opening inventory, purchases, and less drawings. Closing inventory. We have recorded this one, purchases 36,500 and you have to subtract the drawings from that. Then net purchases being 35,200, 35,200, and what more trading expenses? Here we have the opening inventory. We are preparing this date information, but we have been given inventory for the year beginning. So this is opening, the value being 3,000. Add the 3,000 with this 38,200. Closing inventory should always be given the other side adjustment 3,120. I can subtract from the cost of sales. If you prepare the complete financial position statement, then you can treat your gross profit being the difference between these two, 75,430 minus 35,080, 40,350. Trading items are over. And in profit and loss section, if there is any income, you have to first record. So here we have the income. Discount receipt should be addable with this discount receipt. Discount receipt. This value being 1,095. You get the total revenue. Maybe we can subtract the other expenses from this 41,445. Now this one is also over. Now we have to consider only profit and loss sections expenses. 4 item. Here is one more item. Here is one more item. 6 items are there. I'll start with rent and rates. Rent and rates. General expenses. General expenses, we don't have any adjustments. Directly can post 1287. Insurance, we don't have any adjustment. Directly you can write the value 1800. And we have to calculate the depreciation for plant and fixtures and equipment. Depreciation for fixture and equipment based on reducing balance method. So initially we have 80,000 rupees, from there 39,040 is subtracted, and then on that 20% will be calculated. So 80,000 minus 39,040, on that 20%. Okay, 80,000 minus 39,040. This will be the reducing balance or net book value. On that 20% will be calculated. Hope this value is 8,192. Get me this value. Calculate and let me know. Are you getting this? 8,192. This one is also over. And we need to write provision for doubtful debts, which is increasing. So increase in provision for doubtful debts by 30 rupees. You have to consider only 30 rupees. The total expenses being 30,409. If you subtract this from the income, 11,036 will be your profit for the year. Profit for the year. Profit for the year. How the mark is allotted? Whenever there is a subtraction value, while calculating in between, you will be scored 1 mark for this. 1 mark. Here is 1 mark. And the ultimate total 1 mark. And from here I am subtracting now for this 1 mark. And for the revenue 1 mark. And so here subtraction, depreciation, and these are involving cause calculation. No, for all these things you will get 1 mark. Whenever there is a calculation, you will get 1 mark for that. Okay. Now, Here is trade receivable. One more expenses is there. I missed this. What is that? Irrecoverable debt. Irrecoverable debt. Irrecoverable debt. Irrecoverable debt already I posted as PE. 1, 2, 3 PE. Profit section expenses. This is 200 rupees. This is also calculated. So for this you will get another 1 mark. For the final answer 1 mark. So 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11. 11 marks. This question carries 11 marks. See how the mark is allotted. You need to know. Should be very careful to score each and every mark correctly. Okay. So we have to prepare. The next one is all about capital account. I'll prepare here itself. In case of capital account, you know, it's a liabilities. Okay, liability side, credit balance. Credit balance means balance brought down should be in the credit side. Balance carried down should be in the debit side. Okay, and rewrite in the other side as balance brought down. Bring it down to the next side. Transaction increases the value payable to the owner will be shown in the credit side. Decreases will be shown in the debit side. Usually profit will increase the payable amount to owner Fatima, and if there is any drawings, it will reduce. Drawings may be cash or goods. Is that okay? Goods or purchases. Here capital. We start with 59,000 in the beginning, and there is cash drawing 8,580, and there is a drawings of goods 1,300. Profit earned we have calculated in the first preparation, so 11,036. 11,036. Now if you total this, the total being 70,036. 70,036. Balance carried on being 60,156. You have to rewrite to the other side 60,156. How the mark is allotted in this case? So the for drawings calculation 2 marks, and profit for the year transferred here carries 1 mark. If you make any error here, then you will make error here also. And finally the balance brought down to the next side, for that you get another 1 mark. So you will get around and for this 4 marks. Okay, you will get around 4 marks for this. So 4 mark question. Clear? Hope now you will be able to understand the solving the question number 2 involving some adjustments also. The first sum is the basic, next sum involving some adjustments. Now let's move on to the next illustration. Here, Stella started business as a retailer on 1st April 2023. She sells one type of good only. She has not kept a full set of accounting records, but has provided the following information. Half of the Stella's purchase were on cash and half on credit terms. During the year ended 31st March 2024, Stella paid 34,250 to credit suppliers. So here purchase is missing. If purchase is missing, then you can find out the purchases easily by preparing the supplier's account or creditor's account. Okay. So I may prepare the creditor's account here. Trade payables account. Trade payables account. It's only working note. Trade payables. Trade payables being the liability or being the credit balances. So opening should be credit side. Balance carried down should be in the debit side. Transaction increases the amount payable to them will be posted in the credit side. Amount payable to them reduces will be posted in the debit side. Credit purchase will increase the payment to them, and any payment cash or bank will reduce the amount payable to them. Not only that, if there is any purchase return will also be reducing, discount receipt also be reducing. Unless specifically stated, we assume that these things are not available there. So during the year end, year ended 31st March 2024, Stella paid 34,250. So 34,250 is the payment. And on 31st March 24, she owned 2,960 to credit suppliers. Newly started business. This is a clue. So on the year end, so in the year end, so this is the year beginning. Year end, this value being 2,960 means this is the balance carried on. As newly started, initially we don't have trade payables. That's how we can guess. And you can, by solving this, you can find out the credit purchases easily as a balancing figure. Missing data like you can calculate. The total of debit side being 37,210 and here 37,210 and credit purchase being the same value 37,210. Now, from the point number 1, half of the purchases were on cash. So, purchases. In that, cash purchase as well as credit purchase. Credit purchase. Okay, if the total purchase being 1, cash purchase being half and credit purchase also being half. Now, credit purchase we found out here by working this trade payables account separately. We can now find out the total purchase also by the same way. Now, half being 37,210 means another half cash should also be 37,210. Same like, okay. And if you add up these two, you get the total purchases. The total purchases in this case being 74,420. Unlike her competitor, second point, we'll now move on to the second point. Unlike her competitor, Stella made all of her sales for cash only. Sales are only in cash form. Stella markup was 32%. Markup means what? Okay, cost of sales, profit, sales. Okay, if the markup term is used, then the cost of sales being 100 and the profit component being 32 and sales should be 132. That's the relationship. Among the three, if you know any one, you can find out the rest easily. There will not be any complication. So, I just made a statement interpreted as a working note here to be solved later on. Now, we'll move on to the third one. The following amounts were paid for expenses during the year to 31st March 2024. These are the three expenses paid: rent and insurance, wages and other expenses. At 31st March 2024, $300 was unpaid for wages. So wages unpayment is there, so we have to add this. And 500 paid in advance for rent. In case of rent, you have to subtract. Here you have to subtract 500 rupees. And insurance is 2,400 per annum. On 1st April 2023, still paid 3,000 for insurance for all the following 15 months. See, per annum 2,400, but she paid 3,000 rupees for 15 months. So the excess payment 600 will be considered as advance payment or payment in advance. That can be subtracted from the value. This is advance. Advance should be subtracted. Outstanding should be added. Okay, we have done this. Other expenses included 120 paid for vases and flowers. 1/3 of these were for Stella's own home. And Stella treats business cost under 150 as revenue expenditure. So as per her practice, whenever she makes any payment value less than $150 will be considered as revenue only. So this flower and vases being 120 is less than 150 is named as revenue expenditure alone. Though it may be revenue expenditure, in that 1/3 of these were Stella's own home. So you have to subtract this 120 also from other expenses minus 1/3 for the personal purpose should be subtracted. So drawings like, okay. And closing inventory. This is the closing inventory. So we mark down all the adjustments here. Now let's try to finish up this. This will be profit and loss expenses. This will be profit and loss expenses. This will be profit and loss section expenses. And what are the requirement we need to find out? Calculate the total purchases. We have done this for this 3 marks. Already we calculated the total purchase being 74,420. Next, prepare Stella's income statement. So you have to prepare income statement. So in income statement, we have been given the purchases. Right, I'll prepare here sales and less cost of sales. Under cost of sales, opening inventory, purchases, minus closing inventory, you'll get gross profit. Okay. From there you have to subtract profit and loss expenses, rent and insurance. How much is that? 6,750. You have to subtract 500 rupees. After subtracting 500 rupees, okay, and insurance 600 should also be subtracted. This is insurance related, should also be subtracted here only. Okay, you have to subtract two values here. Okay. 6,750, from there you have to subtract 600 and 500 both. Then the ultimate value for rent and insurance being 5,650, and wages 8,300, you have to add 300, so 8,600, and other expenses 1815. From there, 1/3 of 120, 40 rupees should be subtracted, 1775. The total expenses being 16,025. Now we have been given closing inventory being 6,420. Purchases we already calculated, 74,420. What about the opening inventory? Newly started, definitely opening inventory is not applicable. So from 74,420, 6,420 is subtracted to get the cost of sales. The cost of sales in this case being 68,000 rupees. And now we have what? Cost. I'll work out here. Okay. Slightly I adjust the page. Now, cost, profit, sales in percentage. Here it is clearly stated 32% markup. Whenever the term markup is given, cost should be 100, profit should be 32, and sales should be 132. Now we have been given the cost of sales, which is 68,000. So this will be 68,000 rupees. Then you can calculate the profit and the sales also easily by using this working note. 68,000 into 32 divided by 100, your gross profit being 21,760. If this profit being 21,760 and the total being sales 89,760. So sales here being 89,760. From there 68,000 subtracted to get the gross profit 21,760, and your profit and loss section expenses subtracted here to get the profit for the year being 5,735. Question number 4. H Limited provided the following ledger account balances are at 30th April 2025. Rather than H Limited, you can convert that into H Trader or Sole Trader. Because I converted this into basic illustration. In your examination, you have to solve this assuming this being the limited company. Not only that, in that case, you have to prepare a statement of changes in shareholders funds, equity shareholders funds. But those things are skipped because we have to cover that along with the later chapter. This question was asked in June 2025. For this component, it carries 7 marks. Prepare the statement of financial position. Okay, financial position. Statement of financial position. Statement of financial position. Asset as at the date 30th April 2025. So you have two predominant blocks, assets and that non-current assets, and usually intangible assets rare, so unless it is given you no need to worry about that. And current assets, we will now mark them. Fixtures and equipment at book value, non-current assets. Motor vehicle at book value, non-current assets. Inventory, current assets. Trade payables, current liabilities. Trade receivable, current assets. Provision for doubtful debts should be subtracted from the trade receivables. Bank overdraft, current liabilities. And 5% debentures repayable 2029. So 25 currently, repayable only on 2029 means more than 12 months, though then it will be coming under non-current liabilities. Non-current liabilities. So under non-current assets, we have first fixtures and equipment. Fixtures and equipment. This value being 1,55,000. 1,55,000. Motor vehicle also be non-current assets given at book value. Okay, depreciation is already subtracted. Motor vehicle 16,875. No other non-current assets. So the ultimate non-current assets being 1,71,875. Then you have to go for the current assets. Inventory 28,120. Trade receivable also be current assets. Trade receivable 33,000. From there you have to subtract the provision for doubtful debts. This value being 990. After subtracting, the final value being 32,010. So that's all. So if I add these two, I will get total current assets 60,130. Total assets being, you add these two, 2,32,005. Now we will move on to the equity and liability. Equity and liability, or capital and current liability. In case of company, it is equity and liability, otherwise it is only capital and liability. I can name this being capital and liability here. Capital and liability. Under that, capital, non-current liabilities and current liabilities. In capital, we have 1,20,000, and if there is any profit for the year will be addable, and if there is any drawings should be subtracted. We don't have drawings, so you have to add these two. The total capital in this case being 1,94,995. Added 1,20,000 and the profit for the year 74,995. And we have the non-current liabilities. 5% debentures repayable by 2029 means more than 12 months, more than 1 year, so it is non-current liabilities. 5% debentures. If the debenture payable within 12 months, then it will fall under current liabilities. So this value being 5,000. And we have the bank overdraft should also be posted. Last one, that is current liabilities. Bank overdraft. If nothing stated, bank overdraft usually part of current liabilities only. Current liabilities. Apart from that, we have been given the trade payables. So I'll start with the trade payables. Trade payables 26,815, and bank overdraft 5,000 rupees. So 5,195. Then total current liabilities being 32,010. if you total the three items here, you'll get 2,32,005. So you can cross check that asset should be equal to the liabilities. We have correct value. How the mark was awarded? For this calculation, adding these two. For this calculation separately 1 mark. For the ultimate calculation 1 mark. And this one, by adding these two, you will get 1 mark. And guessing correctly, this debenture being non-current liabilities also carries another 1 mark. Trade payables and bank overdraft carries 1 mark. So that's how we will get 7 marks here. So very simple illustration. Hope you will be now able to understand this. Question number 5. Question number 5. Sarah is a trader. She has prepared her income statement for the year ended 31st December 2023. So income statement already prepared. This shows a profit for the year being this much, $20,180. She has closed the ledger accounts for income and expenses and has transferred the closing inventory to the income statement. So closing inventory is there. In income statement itself, we have closing inventory. If the closing inventory is given here, this will be transferable only to the financial position statement as current asset. Okay, remember, this is very, very important. If the closing inventory is given in the trial balance or in the ledger schedule, it will be directly transferable to the balance sheet only. You no need to transfer that to trading section of the trading section of the income statement. Okay. The following balances remain in Sarah's ledger at 31st December 2023. Prepare the inventory account. So you have to prepare inventory account for the year ended, balance the account and bring down the balance at 1st January 2024. So here the inventory you have to calculate being this one. So we have been given inventory in the beginning being 5,811. Year beginning inventory is already available there. Right. Now I have given the inventory format here. You can understand the other way also. This is to calculate missing data, like for the inventory calculation, inventory ledger preparation, you can follow this model also. This model also. For the opening inventory, okay, for the opening inventory, or you can do this way, inventory account. This one is to calculate any missing data. For the inventory account for closing purpose, this one is for closing the books. Okay, for closing purpose, opening inventory should be in the debit side, right? So balance brought down, right? This will be transferable to, okay, this is opening and closing should be in the credit side. Okay, the same way, but we consider only the opening balance and closing balance. Split this into two ledger accounts, like, okay, why? This will be transferable to the income statement, isn't it? You usually transfer this to the income statement, trading section, you know. So I am transferring this as expenses. Closing will be income. So it also be transferable to the income statement. You understand? This is the logic you have to understand. Here. So whenever you are asked to prepare inventory account to close, this model you need to follow. So whenever you show here income statement, this will be transferable to the expenses side of the income statement. Otherwise, trading expenses. And this will be transferable to the income statement. That too as income, trading section income. Hope you'll be now able to understand. So this one you have to understand for the inventory account preparation. Now, let's continue here. I am going to prepare the inventory account separately. Okay. Remember the format, it's very simple format, right, for inventory. Inventory account. Okay. Balance brought down in the beginning. Beginning date being this one, 1st January 23. Balance brought down. And year end, 31st March 24. 31st March 24, balance carried on. Okay. You have to split this into two blocks like. This opening inventory 5811 and closing inventory is given here 6275. 6275. Balance brought down will be transferable to the income statement by the year end. 31st December. This is 31st December, right? Okay. December is the end date. 31st December 23. 31st December 23. It should be transferable to the income statement. It is nothing but expenses of the trading section. In bracket, I may write this way, 5,899. So with that, this one is closed. And this one, 6275 will be transferable to the income statement by the year end, 31st December 23. Income statement. This is a trading section but income. 6275. This balance carried on should be rewritten as the balance brought down for the next period. Balance brought down on 1/1/24. Clear? 6275. Very simple one, but you need to know. That's why I have worked out it separately. Carries 4 marks. Carries 4 mark. Clear? So how the mark is allotted in your examination? For this one, 1 mark. For this one, 1 mark. For this one, 1 mark. And for the proper recording of the date, 1 mark is given. So it is very important for mentioning the date also. Okay. Usually income statement transfer and all happens the last day of the year. And opening balance, opening inventory remains as opening balance as on that date, 1/1/23. Clear? The date also carries mark. 4 marks. Clear? Okay. Now let's move on to the next one. Next one. Prepare capital account. Okay, prepare capital account for the year ended and balance the account and bring down the balance at the 1st January 2024. I am going to solve that now. Capital account. So, capital account. Usually the capital account being the liability item, credit balance. So, in the year beginning, 1st January 23, balance brought down and the year end 31st December 23, balance carried on. Transactions increasing the value payable to the owner will be shown in the credit side. Transaction reducing will be posted on the other side. What are the transaction? Increasing the amount payable to the owners. Okay. Profit earned. And in case of drawings, the drawings could be of cash drawing or goods drawings. Clear? In case of loss, that will also be reducing the value. Now let's start. This shows a profit. For that year, there is a profit of 2180. Profit 2180. And capital in the beginning being 1,15,763. 793. And if there is any drawings, that should be subtracted. 19,260. No more other items are there. Now try to find out where these things will come. Premises will come in the non-current assets. Fixtures and fittings, non-current assets. Accumulated depreciation will be adjusted along with these non-current assets. Trade receivables, current assets. Provision for doubtful debts will be adjusted along with this one. And trade payables, current liabilities. Bank overdraft, current liabilities. Cash, current assets. Long-term loan, non-current liabilities. Wages accrued. Accrued means you supposed to pay it later, so it's a current liabilities. Other payables, this will be named as other payables and receivables. Is that okay? And the capitals were already incorporated here. Okay, now we can prepare the statement here. Now we will finish off calculating the final balance here. The total of this one being 1,35,973. 1,35,973, and the balance carried on here being 1,16,713. Re-rate to the other side 1124 as balance brought down. This value being 1,16,713. 1,16,713. And carries 3 marks. One mark for recording drawings, one mark for profit, one mark for the final balance you brought down here. These 3 marks. And finally, you have to prepare financial position for that period end. Financial position. So, financial position. You know the format. You apply that same format here. First block is all about assets. In that assets, you start with non-current assets and then continue with the current assets. Okay. In liabilities, you have 3 blocks: capital, non-current liabilities, and current liabilities. Let's see. Non-current assets. Asset side. Under that, non-current assets. We have been given the accumulated depreciation. Then you can better write this way. In case of non-current assets, cost, accumulated or provision for depreciation, and then net book value. That net book value will be the final value, will be appearing in the outer column. Premises. First one being the premises, under that cost being 1 lakh. Fixtures and fittings 40,000 rupees. Accumulated depreciation on fixtures and fittings 15,000. Net book value 25,000. Okay. And we don't have accumulated depreciation for the premises, ultimately the value being the same. This value will be the final value, 1,25,000. Only net book value will be posted in the outer column. Current, non-current asset over. We don't have any more. Current assets. Under current assets, we'll start with inventory. The value being 6275. And trade receivable, where you have to subtract the provision for doubtful debts. Trade receivable value being 8,540 minus provision for doubtful debts to be subtracted from here. I post this, which is 427. Net of that being 8,113. Okay, then we have cash being the current assets. Cash being the current assets. This value being 350. Current assets total being 14,738. Total of assets being 1,39,738. Now we will go for the capital and liabilities head. Capital and liabilities head. Capital and liabilities head. We start with capital here. Then the capital we calculated already here. 1,16,713 will be transferable. Okay, 1,16,713. Anyhow, you can give the breakup. Okay, how? Opening capital plus profit minus drawings. That's how you can show it properly also, no problem. Capital is over. Non-current liabilities, yes, of course we have the non-current liabilities. I put the tick mark for that. So non-current liabilities. Long-term loan. This value being 12,000. Apart from that, we have current liabilities, trade payables and bank overdraft. So current liabilities. Under that, trade payables 5,125 and bank overdraft 4,900. The total value being, what more we have? We still have one more item, or other payables. Okay, usually other payables you write after trade payables, and bank overdraft can be written next. So this value being 1,000. Now, question number 6. Anika owns property which she rents out to university students. She has made consistent profit for each year she has been in business. See, rental business, in case of rental business, there will not be purchases, only income. So you don't need to calculate whatever the rental income, there is a gross profit. From there you can subtract the only profit and loss expenses, profit and loss sections only required. Additional information given, prepare income statement of Anika and the capital account. Capital account I may work out here itself. So capital account. So in capital account, in the year beginning, 1st September 21, balance carried on. Profit, if any, will be addable. Drawings, if any, will be subtracted in the year end. The year end being 31st August 22. And finally, the value what you get is the balance carried on. This is brought on, sorry. And this carried on will be written the other side as 1920 to as balance brought down. Here, this is the format. Now, what are the informations are going to be incorporated here? At 31st August 22, rent received 8,100 has been paid in advance. There is an advance rent. So, you have to subtract from the rent receivable, 8,100. 2 entry. See, they have asked only the income statement. Anyhow, I may work out financial position statement also in this illustration, though it is not asked, for your better understanding. Should be posted twice. This will be subtracted, as well as if you are receiving the income in advance, this will be current liabilities. This will be current liabilities. Record 1 and record 2. Subtraction 1, and also you have to treat this being the current liabilities. On August 2022, general expenses $1,300 have been paid in advance and rates 3,400 were owing. General expenses paid in advance, so that should be subtracted. Advance means subtracted 1,300. Not only that, 1,300. And if the expenses paid in advance, this will be your current asset. Will be your current assets. Current liabilities and current assets. And rates 3,400 being owing here, outstanding. In case of rates, there is outstanding. Add 3,400 as the expenses being outstanding, that will be considered as current liabilities. Current liabilities. 1, 2. Insurance includes 1,800 paid for the 15 months period ending on 30th December 2022. So 1,800 is for 15 months, where this year is for only 12 months. So in excess of that 3 months premium will be considered as expenses, income, insurance paid in advance. That should be subtracted. So 3 by 12. So the 3 by 12 on this being, okay, 3 by 12, 1,800 into 3 by 12. 450 will be now adjusted here. 450 and 30th November, right? 3 by 15. This is for 15 month. 3 by 15. Okay. So 1,800 into 3 by 15. This value being 360. This is nothing but payment in advance. So payment in advance should be subtracted, and this will be a current assets. This will be a current assets. Also over. Expenditure of ₹9,000 for new fittings has been recorded in repairs, rectification error. Any new fittings, any expenditure related to that new fittings will be considered as capital expenditure, should be added with the fittings, but they have considered this being the repair. So from the repair you have to subtract this value, the worth being 9,000, and it should be addable with the fittings. It should be addable with the fittings. Double entry is over. Error rectification. And depreciation is to be provided as follows: premises by equal installment and cost SLM method each year over 50 years period. Okay. So premises, it should be depreciated over 50 years. Depreciation, and it should be subtracted in the asset. So the depreciation in this case being 4,18,000 divided by 50. That's what about the depreciation. 4,18,000 divided by 50. 8,360 is the depreciation. So you have to subtract from the asset, as well as this is profit and loss section expenses. And fittings 20% per annum by reducing balance method. In case of fittings, you have to calculate the depreciation at the rate of 20% on RDM, reduced to balance method. Okay. In case of reduced to balance method, from the value you have to subtract the provision for depreciation. This will be adjusted here, this will be adjusted here. So 90,000 rupees minus 71,000 on that 20% will be calculated. 20% is on this 90,000. So 90 plus there is already 9,000 is going to be added because of the error. 99,000 minus 71,000 into 99,000 minus 71,000 into 20%. 5,600 will be the depreciation. Depreciation here being 5,600. Okay, will be the P&L section expenses, as well as it will be a provision for depreciation should be addable there. Provision for depreciation. So this should also be provision for depreciation. addable to provision for depreciation. Right. So all the things are posted here. Let's now start with capital. We'll take to the capital account 4 lakhs. So here 4 lakhs. And then rent receivable. We don't have the trading section, only rent. Okay, we don't have the purchases here. You are just letting out the property and earning the money. We don't have any other revenue, means trading section expenses here. So this is the revenue. General expenses, profit and loss section expenses, bank, current assets, rate, profit and loss section expenses, insurance, profit and loss section expenses, repairs, profit and loss section expenses, and drawings will be adjustable in the capital account 18,500, and then we have these non-current assets under this one. So we still have profit section expenses being the depreciation for the premises, as well as being the expenses for depreciation for fittings also. So I have marked down all this value. Let's start with the income statement. Income statement. Income statement. Under income statement, rent receivable. Rent will be the main income. Rent received. How much is that? From 1,62,000, 8,100 is subtracted. So the value being 1,53,900, and rest of the things are being the expenses. One is general expenses, the value being 26,500. Okay, I put the tick mark for all the values incorporated. This one is subtracted. Okay, rent receipt, rent receipt, rent receivable, 1,62,000 minus 8,100, 1,53,000, 1,53,900. This one is over, but you have to write the current liabilities later. Then general expenses, general expenses. General expenses being 26,500 minus 1,300 to be subtracted. 1,300. I write in short. The value being 25,200, and rates 38,200. You have to add 3,400, then final value being 41,600. Okay, then insurance 12,400. You have to subtract 360, then the value being 12,040. While calculating the subtraction additions in the inner column, you know, are used in thousands value, 3 zeros cut. Okay, and in case of repairs 32, but I have to subtract 9,000 from here. Then the ultimate value being 23,000. Drawings already posted. There's a depreciation for premises. Depreciation for premises premises. How much is that? 8,360. We have completed this one, 8,360. For fittings, the value being 5,600. 5,600 fittings. Okay. If I add up all the expenses, the total being 1,15,800. If I subtract this from rent receivable, you will get the profit for the year. Profit for the year. For the year. The value being 38,100. Whatever the value you get will be transferable to the capital account. So I have the capital account here. I am adding the 38,100 here. Now I can finish off the capital account also. 4,38,100. 4,38,100. The balancing figure being 4,19,600. Balance brought down being 4,19,600. We got all this value. We got all this value. Is that okay? So the requirement is fulfilled. Income statement completed. Capital account also completed. 9 plus 3. 12 marks over. Anyhow, I will make you understand the preparation of the financial statement, financial position statement also by continuing the same illustration. Let's see here. Financial position statement. Financial position. Of course, not asked in this examination, but maybe you may learn this better. Okay. So here we have the capital and assets. First one. Under assets we have three predominant assets. One is non-current assets tangible, another one is non-current assets intangible, another one is being current assets. These three. Let's finish up the current assets, non-current assets first of all. Premises being the non-current assets. You have cost and accumulated depreciation and net book value. These are the three values you have to write. Cost for the non-current assets being actually premises. We'll start with the premises. Premises 4,18,000 rupees will be the value here. And the depreciation, rather than subtracting from the cost, you can add this with the provision for the depreciation. 8,360. 8,360. Now the provision for depreciation being how much? 50,360. 50,360. And net book value being 4,18,000 minus 50,360. This ultimate value being 3,67,640. Next we will go for the fittings. Fittings. Under fittings, 90, you have to add this 9,000. 99,000 is a cost. And accumulated depreciation being already depreciation accumulated available being 71,000. With that current year depreciation 56,000 should also be addable. So these two. 71 plus 5,600. 71,000 plus 5,600. This value being 76,600. 76,600. So whatever the depreciation you create will be now considered as profit and loss section expenses, and it will be added with the accumulated depreciation, and that will be subtracted from your overall cost of the assets. From the 90,000 you will be subtracting 76,600. Then the value being net book value being 13,400. Now overall net book value of non-current assets being 3,67,640, with by adding 13,400 you will be getting 3,81,040. Now we have to find out the current assets. Under current assets, what are the current assets we have? So we start with the inventory. Okay, do we have inventory? Okay, capital, rent, receivables, bank. Okay, we don't have inventory, but we have the bank, so I have to record that bank here. Bank being 39,400. 39,400. Apart from that, This 1300 being the current assets may be other receivables, named as other receivables. Other receivables being 1300, and here is also insurance, that will be another 360. And do we have any other current assets? This will be called as other receivables. Here is also other receivables. So we have posted this one. We don't have any other current assets here. So only these two will be named as other receivable. 1660. Now cross verify. Do we have any other item unticked? Okay. No. Premises recorded, fittings recorded, premises accumulated depreciation for premises and fittings also recorded, and current assets recorded, that's all. The overall current assets being 41,060. Then total being 4,22,100. Now we'll go for the capital and liabilities. Second block. Under that we start with the capital. Capital, already we prepared capital account and we got the balance here being 4,19,600. So 4,19,600. Now you have to cross verify, do we have any non-current liabilities? No sir, we don't have any non-current liabilities. Everything got ticked. Only these two are pending. So this one and this one. Okay. That will be called as current liabilities, especially other payables. This one being 8,100 and this one being 3,400. Current liabilities. Okay. So the value being 8,100 plus 3,400, 11,500. Now we understand that depreciation was not subtracted from this profit for the year 3,800. Okay. See, there is a small correction. In fittings 90 and you have to include another 9,000 for the error rectification. Right. So if I add the 9,000, this value becomes 22,400 and this value becomes 3,90,000. Then overall value being 3,90,040 plus 41,060, 4,31,100. 4,31,100. And if I total the capital and liabilities also, you get the same number, 4,31,100. Hope you will be now able to understand. To prepare a comprehensive illustration, after the preparation of income statement, you can prepare the financial position also. Clear? Of course, in the examination, they have not asked the financial position, but for making you understand, I solved that one also. Okay. So for the double entry, whatever the transactions we supposed to adjust from the adjustment, you have to record twice. One is here, another one is being either current liabilities or current assets. One is subtracted here, another one is added here. That's how we do, so that we get all the things completely solved. Now we will deal with question number 7. Question number 7. Viraj is a retailer. He buys on credit and sells for cash. He rents out an area of the shop to another business for $172 per month. Rents out an area. Okay. So what is the requirement? You need to prepare income statement for Viraj as well as you have to prepare current liability section only in financial position. Though they have asked only the current liability section, I may prepare complete financial positions for your better understanding. Always remember, you have to finish off adjustments first of all. Closing inventory given in additional information will be posted twice. One is in trading section as income, another one being it should be posted in the current assets. Depreciation on fixtures and fitting is to be charged at a 15% per annum using straight line method. So I will now finish up this one, depreciation. So under depreciation, fixtures and fittings under straight line method, so you can directly calculate 15% on this. 15% on this being 12,500 into 15%. Okay. 1875. 1875 is the depreciation. 1875. So you have to add with this, and it will be profit and loss section expenses. Two records. One is added here, another one is recorded here. And rental income included in the amount due for the period from 1st February to 30th April 2025. Okay. So rental income included the amount due for the period. The amount what you have received is representing the rental income for February onwards, but we have to close the books of account on 31st January. So from 1st February to 30th April, February, March, April, 3 months rent to be received in advance. The per month rental income clearly stated being 172. So 3 into 172 is the amount received in advance. Okay, 3 into 72. 172. So 172 into 3, 516 rupees you received in advance. Now that should be now subtracted. Okay, 516. How? 516 should be subtracted from here, minus 516. Not only that, this is one record, another one being, this will be considered as current liabilities because you received the income in advance. You received the income in advance. Okay. You have to remember all these things. Right. I mark two boxes here. One box representing subtracting, another box is representing that it should be taken to the current liabilities. And at 31st January 2025, Viraj owed 282 for wages. So there is an outstanding wages 282. So here add 282. As the amount supposed to be payable, it's a liability part of current liabilities. It's a part of current liabilities. Is that clear? And then 55 for advertising. For advertisement, there is a outstanding. Okay. So in advertisement also you have to add this 55. Double entry. One is addition, another one is it's part of current liabilities. Pair. Should record twice. Okay. And then after the trial balance was prepared, Viraj received a bank statement which showed that bank charges 13 had been paid in January 2025. So after the receipt of the bank statement only we came to know we have paid the bank charges. So now what happens? If you know this, you may record this automatically. This will be addable with the bank charges 1, and it may be subtracted from the bank account, but already we have the bank overdraft. So it's a negative will be added. Is that okay? So you say that you have 1260 negative in your bank account. On seeing the statement, you further noticed another 13 rupees also deducted from 1260. So the overdraft being not 1260, it's 1273 by adding the 13. And you have to consider this being the bank charges by adding with the existing bank charges 143. So 143 plus 13. So we have incorporated all these things. Let me start the preparation of income statement. Income statement for the year in the books of Viraj. Revenue being 89,600, I mean mark this trading income, rental income being the profit and loss income, sales return, trading income subtracting item, otherwise name this being the trading expenses, inventory in the beginning, trading expenses in the beginning, right? Then purchases being trading expenses, rent and insurance being profit and loss expenses, general expenses, profit and loss expenses, wages, profit and loss expenses, stationery and advertising, profit and loss expenses, bank charges, profit and loss expenses, fixtures and fittings being the non-current assets and it will be adjusted after the provision for depreciation, trade payables being current liabilities, bank overdraft current liabilities, capital and drawings will be adjusted in capital account itself. It's capital account. Is that okay? Capital. Now this should be posted twice, inventory also. Let's now start. Revenue. I'll put the tick mark for all the items I posted. Okay. Revenue. 89,600. 89,600. And sales return related to that should be subtracted. Sales return. This value being 2,195. After subtracting the ultimate net revenue being 87,405. Now from that you have to subtract cost of sales. Cost of sales. And in cost of sale we start with opening inventory. Opening inventory. The opening inventory in this case being this one 4,500. 4,500. Then purchases should be added with this. Purchases, this one 53,700. Overall value being 58,200. Subtract the closing inventory. Closing inventory. Closing inventory, this one, right? So trading income to be subtracted 5,900. Still we need to record again 5,900 is subtracted. Then the ultimate value being the cost of goods sold 52,300. 52,300. Then the value what you get is called gross profit. Gross profit. The gross profit in this case being 35,105. 35,105. Now with that P&L account related income if any will be taken. So here we have been given rental income. Rental income will be addable here. Rental income. Rental income being 2580. And there is an item to be subtracted. 516 is subtracted here. So after subtracting, the final rental income being 2064. 2064. And 37,169 will be the total value. Then we have to subtract the P&L section expenses one after one. We have been given rent and insurance. Rent and insurance, no adjustments with respect to this one. So rent and insurance. This value being 8760. General expenses. Okay. General expenses 2945 and wages 7350. Don't forget to adjust for this 282. After adding 282 you will get 7632. Stationery and advertising, the value being 710, and you have to add 55 with this 765. bank charges 143 plus 13, 143 plus 13, the value being 156, 156, and here we have depreciation for fixtures and fittings, depreciation for fixtures and fittings, the value being 1875, 1875. No other items are available for posting in the income statement. So now I total this. The total being 22,133 is going to be subtracted from our total income. You will get the profit for the year. Profit for the year. For the year. The profit for the year in this case being 15,036. 15,036. So with that we have completed the income statement preparation. Now we have to prepare only current liability section for your examination. But anyhow, I will prepare the financial positions statement completely. Better you know the capital balance. So the current year profit being 15,036 and closing inventory being, this is profit. Closing profit means the closing inventory being 5,900 to be posted. So that I score out here. Okay. So now from this trial balance I am going to prepare the financial position statement. If you are clear with this, let me know so that I will directly go for the preparation of financial position statement. Yeah. So I'll move the page this side. I prepare now. Financial position statement. Financial position statement. Okay. Under financial position statement, we have to prepare all the assets and liabilities values here. Let's start with the assets. Right. In assets block, start with non-current assets. Under non-current assets, we have only one item, fixtures and fittings. Here we need to have 3 blocks. In case of non-current asset, cost, accumulated depreciation or provision for depreciation, net book value. So we have fixtures and fittings, the value being 12,500. Fixtures and fittings, 12,500. And accumulated depreciation 3750, with that this value should also be added. Then the value being 3750, initially in this year we added another 1875 with that, so the total value being 5625. 5625. I mark here. This is addition of these two, 3750 plus 1875. The net to book value being, after subtracting this accumulated depreciation from the cost, you will get 6,875. So you put the tick mark for all these value, it's over. Then do we have any other non-current assets? No. Only one non-current assets also over. So all these things are over. Then we'll go for the current assets. Under current assets, we have the inventory, closing inventory to be recorded here. Inventory. Inventory value being 5,900. 5,900. Do we have any other current assets? Currently we don't have any current assets, only current liabilities. So 5,900. Okay. This will be here 6,875. This will be 5,900. Right. Now the total being 12,775. And in capital and liabilities, start with the capital. We started with the capital being 7793. You have to add the profit earned in the current year, profit for the current year. Okay, 15,036. Then the total being 7793 plus 15,036, 22,829 less drawings. Drawings here being 15,305. 15,305. So minus 15,305. Then it will be 7,524. And do we have any non-current liabilities? Nil. We'll go for the current liabilities. Three parts are there. Okay. Third part is all about current liabilities. Here is current liabilities, other payables. Okay. Before we go for that, we'll finish up the trade payables first. Trade payables being 3125. And these items 1, 2, 3 are other payables, will be named as other payables. So the value being 516, I put the value here, 516, 282, 55. Don't get confused with minus and plus. All these things are current liabilities only. So you have to total all these things as being the current liabilities here. Minus and plus will be respective item. Okay, in that respective income and expenses, you have to do minus and plus. But if it is being the current liabilities, you add all the three, stating this being the current liabilities. Other payables. Or this one may be named separately, this current liabilities. Other payable, leaving 560, you can take these two, 282 and 55. 282 and 55. This will be, in total, will be called as other payables. This 516 is the rental income received in advance. No, you can name this being income prepaid. Income prepaid. Income prepaid in this case being 516. This value. That's how you can now number this. Still we have the bank overdraft. Bank overdraft. OD. The bank overdraft in this case being 12,060. With that you have to add the 13 rupees. The value being 1273. Then overall the four items value being 5251. 5251. If you add this non-current liabilities and capital 7524, you get the total value 5251. The total value should match with the total value of the asset. Yes, to ensure that you have not made any mistakes. Clear? Hope you will be now able to understand. Let's try to solve the question number 8. Zamir is in business providing legal services. See, if it is being the legal services, usually you don't have any opening stock or closing inventory. We don't have inventory, so opening or closing inventory we don't have. Then sum becomes very easy. Zamir provided the following balances from his books of account at 31st December 2020. Additional information, requirement being prepare Zamir's income statement, prepare asset section of Zamir. You have to prepare only asset section. Though they have asked only asset section, I may prepare completely for your better understanding. Is that okay? Let's try to solve this illustration. First, to finish up the adjustments. The annual rent is 16,000. On December 2020, rent was paid to cover the period from 1st January to 31st March 21. See, we have to close the books of account on 1st December, but we paid in addition to the required rent for the period meant for January to 31st March, 3 months. 16,000 is for the full year's rent, but for the 3 months, this is for annual rent. So you have to calculate 3 months rent, 3 by 12. This will be now considered as advance rent advance. Okay. What happens in this case? In case of rent payment in advance, it should be addable here, 4,000 rupees, subtracted here. Not only that, if you pay the rent in advance, it is your asset named as current asset. Record twice. Is that clear? And then rates of $6,000 were paid during the year 31st December 2020. The payment covered the period from 1st January 2022 to 31st October 2020 only. From 1st November 2020, annual rates were 7,560. So, for this period it is 6,000. But for the remaining period we have to calculate. Okay, from 1st November onwards, the annual rate being 7,560. See, now 1st January, I will work out this one here. 1st January 2020 to 31st December 2020. This is one full year. 31st December 2020. But this 6,000 is applicable only up to 31st October. 31st October 2020. Thereafter, from the next date onwards for 1 year, 1 year means from this date to the next year, 31/10/2021. In this period, annual premium being 6,000, here the annual premium being 7,560. This is for 12 months. This is for 12 months. Okay. Clear? From 1/1/2020 to 31st December 2020, we supposed to prepare. For this, you have to find out what is the rate you supposed to pay. Up to this period, the annual premium rate being 6,000. After this date for 1 year, the rate being 7,560. Now I have to prepare and find out the rates applicable from 1/1/20 to this date. Now we have cheaper rates in this period, thereafter costlier. How many months we pay at the cheaper rate? From here to here, 10 months we pay cheaper, and from 31st October 2020 onwards for the remaining 2 months we pay higher or costlier rates. And here 6,000 for 1 year means for 10 months how much it should be? Divided by 12. Isn't that okay? And in this period 7,560 is for the 12 months means for 2 months how much it should be. Okay, so we need to calculate for the 12 months. For the first 10 months, it's cheaper. 6,000 rupees for 1 full year means for the 10 months it should be 5,000 rupees. And for the remaining 2 months we paid 7,560 per annum. Per annum 7,560 means per month you have to calculate and multiply with the 2 months value here. The 2 months value here being 7,560 into 2 by 12. The value being 1,260. Then overall rates being 6,260 for this period. 6,260 for this period. Clear? In this, the payment for this period remains pending from 1st November to this year end pending. For that period, how much should be payable? 1,260. It is clearly stated. The payment covered from 1st January to this date. November and December payment is pending. For these 2 months, the amount payable being 1,260. This is outstanding. So outstanding should be added. add 1260, and then this will be pending to be payable, no, named as current liabilities. Pending to be payable named as current liabilities. Do two adjustments. Third, depreciation is to be charged on office equipment at 15% per annum. Using SLM method, no depreciation is charged in the year of disposal. If you are selling any equipment, you don't charge any depreciation for this year. For whatever the assets you have, you can charge the depreciation under straight line method. In February 2020, office equipment was sold for $1,000. This equipment had been purchased for $1,800 on 1st January 2018. The sale proceeds have been debited to the bank account and credited to the proceeds of disposal of office equipment account. No other entries have been made in respect of the disposal. Of course, these two transactions can be handled only when you have the knowledge about depreciation. So I may brief the depreciation and then I will explain this illustration to be solved. I will keep it pending. Once of Zamir's client has become bankrupt, okay, the client owed $1885. Zamir does not expect to record this amount, so there's a irrecoverable debt. Okay, so irrecoverable debt. In trade receivable 15,600, you have to subtract this one, the value being 1885. 1885 should be subtracted. Not only that, this becomes your expenses related to the profit and loss section. So profit and loss expenses. Clear? Profit and loss expenses. So now we left with third and fourth point to be covered. Now I need to complete point number 3 and point number 4 together with depreciation is to be charged on office equipment at 15% per annum using straight line method. No depreciation is charged in the year of disposal. So in the year of disposal, you don't charge any depreciation. Is that okay? That's the first point. So from this it is very clear, rate of depreciation being 15%. This information is needed. Third point, in February 2020, the fourth point, I may include in the very first page to compare and solve this. Okay, to compare and solve this. Okay, so rate of depreciation being 15%. In February 2020, office equipment was sold for 1,000. Now I will write here office equipment, cost, accumulated depreciation on that. After subtracting, you would get what? Net book value. In the beginning, we have cost being 60,000. Provision for depreciation in the beginning being 22,500. 22,500. Is that okay? In February 2020, office equipment was sold for 1,000. This equipment has been purchased for $1,800 on 1st January. So there is a sale, minus sale. Actually 1,800 rupees worth machinery is going to be sold. That was purchased on 1st January 2018. Okay, 1st January 2018. Sold on which date? February 2020. So first year ends on 31st December 2018. Second year ends on 31st December 2019. This is part of the year. Usually in the year of sale, we don't provide any depreciation. For this sold asset, we already used for 2 years, right? So we might have created 2 years depreciation in accumulated depreciation. Okay, accumulated in this. 1800, the applicable rate of depreciation in this case being 15%. 15%. So 15% for how many years? 2 years. So 1800 into 15% for 2 years. 1800 into 15% for 2 years. 540. Okay, you will get 500 and, sorry, 1 second, 1800 into 15%. 270 per year for 2 years. 540. Yeah. 540. Okay. So after the sale, balance asset being 58,800. Balance accumulated depreciation being 22,500 minus 540, balance accumulated depreciation being 21,960. 21,960. And now listen. Asset 540 is already depreciated and it is accumulated depreciation on the asset. So net book value for this asset, how much is that? Net being 1,260 only. But this one sold for how much? 1,000. Was sold for 1,000. Isn't it? This one is sold for 1,000. This equipment had been purchased 1800. As it was purchased in 2018, we created the depreciation for the 2 years, which is 540, and sold for 1,000. 260 we get lesser. This lesser amount is nothing but loss on sale of the asset. Loss on sale of the asset being the profit and loss section expenses. Okay, clear? Now this one will not be available. This one will not be available. Okay. This 1,000 will be removed from where? Office equipment. Proceeds of disposal of office equipment. This is also be recorded. This is also be recorded. We have completed all the three simultaneously. And what method of depreciation we have to follow? Straight line method of depreciation. Now depreciation for the current year. Current year depreciation. Under straight line method means you have to calculate on this value directly 15%. For the current year, 58,800 into 15%. 8,000. Okay. This is 58,200. Okay. 58,200. Right. So for 58,200, you have to calculate the rate of 15%, which is 8,730. 8,730. This is current year's depreciation. Okay, sorry. 8,730. Now, overall value 58,200. Accumulated depreciation, the balance asset we have here being 8,730 plus 21,960. 30,690. And net book value being 27,510. 27,510. Apart from that, there's a loss on sale. Loss on sale being 260. This is the amount to be adjusted where? In profit and loss section as expenses. In profit and loss section as expenses. Clear? Okay. See, you raise the question, why do we cancel the proceeds of disposal of office equipment? Okay, let me explain. What is the journal you usually pass while selling the asset? Bank account, usually you debit, and asset account should be credited. That's the format. Okay, let's see what happens here. I am going to do a rectification like here. Rectification like here. The sale proceed 1,000 shown this way. This one is debit, this one is credit. This is the correct approach. This is the correct approach. But what they have done? Bank debited and disposal account is credited. Now, to bring this correct answer, I have to remove the disposal. How do I remove? Credit is removed by debiting. And what to be credited? The correct entry to be credited is asset in the asset account. 1000. Okay. Now check. If you combine this one, disposal credit, disposal debit, cancel, then you get the original journal entry. Original journal. This one is passed. Now I have to pass this one. So I subtracted 1000 rupees from asset. How the subtraction happens? 1000 rupees sale value and accumulated depreciation 540, loss on sale 260. This is what about the full 1800. As we subtracted from here, disposal account should be debited. Already we have disposal account here in credit side, it is cancelled. That's how the disposal account is now going out. Hope we will be now able to understand this simple logic. Simple logic. Okay. So we have completed all this posting. You need to prepare income statement and asset section. In asset section, so I think I now can erase all these things. Okay, so I have cancelled, so that we will now be able to understand the required items only. These are the asset related, so we have adjusted the final asset value being this one. Do we have any other assets? No, we don't have any other assets. Apart from that, we have the trade receivable asset. Trade receivable asset. Okay. And fee income, trading income, rent and rates, P&L account expenses, salaries, P&L account expenses, stationery advertising, P&L account expenses, electricity P&L account expenses, bank charges P&L account expenses. This one is already solved. Bank overdraft, current liabilities, trade receivables, current assets, capital can be shown here. Okay. And loss on sale being the P&L section expenses. Loss on sale. Okay. Let me now prepare the income statement in this side. Income statement in this side. Okay. Income statement. Don't forget to adjust the depreciation and this one. Okay. I think I may solve the other side. Okay, here itself. Okay. Fee income. Fee income. We start with fee income. 1,51,750. And all other are related to the P&L section expenses only. Rent and rates. Rent and rates. The value being 26,000. Add 1,260 minus 4,000. I incorporated these two. Okay. 26 minus 4,000 plus 1,260, 23,260. Salaries 55,000. Stationery and advertising. Stationery and advertising. 6,450. Electricity. Electricity. 8,000. Bank charges. 4,100. And we have two more items, depreciation and loss on sale. Loss on sale of the assets. Okay. And this one is all about irrecoverable debt. Here is irrecoverable debt. Irrecoverable debt. Irrecoverable debt here being 1885 and depreciation being 8,730 for the current year. Current year depreciation is item of expenses, okay, 8,730, and there is a loss on sale 260 also be an expenses here. Loss on sale 260. Now find out the total value here. The total value being 1,07,685. Then profit for the year. Profit for the year 44,065. Profit for the year 44,065. Yeah, we'll now finish off financial position also. If you have any doubt, you can ask me, else I will go for preparing financial position statement. Okay. Now let's move on to the next one. Income statement, the financial position statement. To make it short, I will directly go for the assets. In assets, we have non-current assets being this much, 27,510. I directly write here, as the elaborated information is already posted, I just take the final value here, 27,510. And do we have any other current assets? Yes, we don't have non-current assets, only this one. Apart from that, we have the current assets. Current assets being trade receivables. In trade receivables, 15,600. Irrecoverable debt 1885 should be subtracted. After subtracting this irrecoverable debt, the final value being 13,715. 13,715. This is over. Here is also one more current assets. This 4,000. Rent and rates. Rent and rates paid in advance. Other receivable, named as other receivable. Okay, other receivables. 4,000 rupees. Then total value being 17,715. No other current assets we have. So these two are the assets. Total being 45,225. They have not asked the liability section. Anyhow, we will write the liability section also. Capital and liability section. Capital and liability section. Capital and liability section. Under that, we start with the capital. Capital 57,000. Add profit. This is the profit. Okay. Minus the drawings. 57,000. Add profit. 44,065. Okay. Minus drawings. Minus drawings 65,000. Okay. 57,000. Add 44,065 minus 65,000. The value being 36,065. This value being 12,935. 12,935. So completed. Now we don't have the non-current liabilities, we have current liabilities only. So under current liabilities, here is rent and rates, other payables, value being 1260. And bank overdraft also we have, bank overdraft 7,900. We have completed all this posting. 7,900 plus 1260, 9,160. If I tally the capital and liability side, hope I will be getting the asset side value 45,225. That's all. Clear? Let's now move on to the 9th question. This question also asked in October, November 22. Okay, 12 marks, carrying 12 marks. Okay. Okay, once again. Carrying 12 marks. Now, you have to prepare the income statement as well as you have to prepare the calculate the working capital also. Working capital is nothing but the difference between current assets and current liabilities. You have to calculate current assets and current liabilities and subtract. So anyhow, I will solve this illustration along with the financial position also. Once financial position is solved, then you can directly get the working capital without any trouble. Though financial position statement not asked, for the understanding purpose, I will solve this one also, right? Closing inventory. Closing inventory will be adjusted later on. Where it should be trading item, trading section income, and it will be current assets. Okay, you have to record twice. So once you record once, that can be ticked. That's how you can do. Commission received 800 was owing at 31st August 2022. There's an outstanding commission. Okay, outstanding commission 200 rupees. So where is that commission receivable? Outstanding should be addable, and that there is also an income, right? As this is being income receivable is your asset named as current asset. Income receivable, current assets. Then third one, the balance shown for salaries covers the 11 months to July 31st, 2022. Salaries for August 22 are due and unpaid. There have been no salary increase over the previous 12 months and equal amount is paid each month. So currently the salary being only 11 months available here, you have to add one more month. The salary remains constant for every month, there is no any change. So here the salary being 53,900, you know, this 53,900 is for 11 months. Then what about the per month salary? The per month salary being 4,900. Per month salary being 4,900. 53,900 divided by 11. 4,900. This is being outstanding. So add this 4,900. As the expenses being outstanding, this will be current liabilities. This will be current liabilities. Related to this. Right. And next, fourth, at 31st August 22, rates were prepaid. Then prepaid should be subtracted in from the rates. 300 should be subtracted, and expenses paid in advance being your asset, named as current asset. Okay. The insurance included 700 covering a private insurance premium for BC. Private insurance, personal, it is drawings. So from the insurance you have to subtract insurance premium. 700 rupees should be subtracted, and this is part of the drawing. So you can add with the drawings if it is given. As it is not given, we name this being the drawings. We can subtract this drawings later on from the capital account. And repairs included 4,000 that related to a new attachment for a machine. New attachment. Any new attachment, any first time expenses, you do know it's a capital nature. Capital nature should be treated as a asset only, but they have considered this being the repair. So from the repair, it should be removed. Minus 4,000. And it should be a part of machinery account. So you have to add that with the machinery account. The value being 4,000 should be addable here. Now, machinery is to be depreciated at the rate of 20% per annum by reducing balance method. A full year's depreciation is charged regardless of the date of any purchase. There will be no disposal during the year. Premises are not depreciated. So premises supposed to be depreciated. Premises not depreciated. Only machinery is going to be depreciated. That too, the depreciation applicable for that is 20% under RBM, reduced balance method. So the machinery value being 52,000 plus 4,000 should be added as there is an error, and accumulated depreciation on this 28,400 should be subtracted. This will be the net book value as we are following the reduced balance method. On this you have to calculate depreciation at the rate of 20%. Come on, 20% on this being 52,000 plus 4,000 minus 28,400 into 20%. 5,520 will be the depreciation here. 5,520. This is the depreciation. Okay. Now you have to add with accumulated depreciation, and this is a part of P&L section expenses. P&L section expenses. So all the things are now noted here to be adjusted. So now we can prepare the income statement easily. Name this purchases, trading section expenses, revenue, trading section income, sales return, trading section expenses are deductible from the revenue. So we prepare the financial statements for 31st August 2022. This inventory being the opening inventory being trading expenses, capital will go to the capital, bank being current assets, non-current asset, this is a set. We will adjust that later on. And commission receivable, this is a P&L section income, trade receivable, current assets, trade payables, current liabilities, discount allowed, P&L section expenses, discount receipt, P&L section income, insurance, P&L section expenses, repairs, P&L section expenses, salaries, P&L section expenses, rates, P&L section expenses, carriage in, part of the purchases. So trade expenses, trading section expenses. Okay. The depreciation being 5,520. 5,520 depreciation. 5,520. One is depreciation, P&L section expenses. Another one, it should be added with the accumulated depreciation. I need the space here. Okay. Now we prepare the income statement, and we have been given the closing stock also. I may post that here. Closing stock 12,000 rupees. Inventory, closing inventory. Okay. One should be in trading income, another should be current assets. I just posted in the very first page itself for my easy working. Let's start with the income statement. Income statement. Purchase. We start with the revenue here. Revenue. 2,31,500 minus sales return 3,600, 2,27,900. Trading expenses, cost of sales, opening inventory, purchases, opening inventory being 11,100, purchases being 1,20,000. And don't forget to the trading expenses here is there. Carriage in also part of purchases. This value being 400. And we still have closing inventory to be adjusted. The total of these three value 1,31,500 minus closing inventory. Closing inventory here being this one. I am going to complete this one. 12,000 rupees. After subtracting 12,000 from here, the value being 1,19,500 and the gross profit being 1,08,400. We will now proceed for the P&L sections. In P&L section, first you start with the P&L. In overall value you have, then any other PI. So here is also one more PI, commission receivable. In case of commission receivable, you have to add 800 with this 2,200. Then the value being 3,000. The overall income being 1,12,800. Now we can subtract the expenses related to the P&L section one after one. So capital, current assets, and here is discount allowed. We'll start with the discount allowed. The value being 600. And insurance. In case of insurance, 9,600 minus this 700, 8,900. Repairs, 53, 12,400, and you have to minus 4,000, so 8,400. Salaries, 53,900, and you have to add this 4,900. Then the ultimate value being 58,800. And rates, we have to adjust this 300, 6,000 minus 300, 5,700. Then where is PE? Here is PE, depreciation for the year, especially for machinery, 5,520. All these expenses put together totaled 87,920 is subtracted from your total income. You will get the profit for the year. Okay, profit for the year 24,880. Clear? This 24,880 will be addable with the capital? No. Yeah. If it is clear, message me so that I will move on to financial position statement also. Okay, clear. I'll move on to the other side. Yes. Financial position. They have asked only working capital. For the working capital, you need to calculate current assets as well as current liabilities and find the difference. That's okay. But anyhow, I'll complete this for your understanding fully. Financial position. Under non-current assets, we'll start with. Under non-current assets, we'll start with. Okay. We have to start with the cost, accumulated depreciation, and net book value. We start with this one. Premises 98,000. No accumulated depreciation on that, so 98,000. In case of machinery, 52 plus 4,000, 56,000. That 4,000 is an error, so we rectified that here. And accumulated depreciation on this being 28,400 plus 5,520. You have to add these two. 28,400 plus 5,520. The total value being 33,920. 33,920. If I subtract this, then the net book value being 22,080. So we don't have any other non-current assets. The total of non-current assets being 75,920. 75,009. Okay, sorry. 98,000 plus 22,080. 1,20,080. 1,20,080. 1,20,080. Now we have to add up the current assets here. Under that, you start with the inventory. It remains unticked. Inventory. Usually you start inventory being the first one in current assets. 12,000. That's better. And any current assets, so here is commission receivable. Commission receivable. Okay. Maybe other receivables. Maybe other receivables. Value being 800. Okay. Other receivables being 800. Here is current assets, trade receivables. Already we marked all these items. Trade receivables. This value being 19,200. This value being 19,200. And here is rates. This is prepaid. Prepaid. We paid in advance. Prepaid rates. This value being 300. Do we have any other current assets? Here is bank. But the bank balance is in the credit side. Be careful. Asset means it should be only in the debit side, but if it is given in the credit side, what does it mean? This will be overdraft. I have not noted by the time now I referred. This seems to be credit side, right? So it is not current asset. It may go to the current liability side. Is that okay? Current liability section. You have to be double cautious. Do we have any other current assets? CA? We don't have CA here. Okay. We have incorporated all these things. Now the total of current assets being 32,300. Total of all the assets being 1,52,380. Now capital and liabilities. Capital and liabilities. There capital Capital will start with 1,11,900. Profit for the year 24,880 should be added. Profit for the year 24,880. So 1,11,900 plus 24,880. This value being 1,36,780. And here is drawings should be subtracted. Drawings being 700 to be subtracted. So the ultimate capital balance being 1,36,080. Now non-current liabilities we don't have, but we have the current liabilities. I will now list those items. Okay, tick, 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 tick. Okay. So bank overdraft. So this is a new one. All these things are also over. And here we have the trade payables. We'll start with the trade payables. Trade payables. This value being 7,300 over. And here is salaries may be outstanding, means other payables. Other payables being 4,900. Bank being in the credit side representing overdraft. So liabilities, so bank overdraft. Not stated as overdraft, but you can guess it easily that this amount is in the credit side. So based on that, you can easily guess it's being the current liabilities only, 4,100. The total of current liabilities being 16,300. If I total the capital and liabilities, the total value is 1,53,000, 1,53,080. 700 rupees difference is there. We'll try to identify where the difference. I have seen somewhere 700 rupees. Okay, drawings. Okay. Now, I will locate that beforehand. What is the question? You have to find out the working capital. Working capital in this case is equal to current assets minus current liabilities. Current assets being 32,300 and current liabilities being 16,300. Then your working capital is 16,000 rupees. We got this answer easily. Clear? So this number 1,52,380 only you are getting. Okay. 1,36,080 plus 16,300, 1,52,380 only. While calculating rather than taking, I have chosen this one by oversight. Okay. Now hope you will be now able to understand this lesson.